Hello, everyone, and thank you so much for joining us. This is Georgie Carter from the Health Policy Plus project. I am delighted to welcome you to today's webinar, How Can Blended Financing Help Catalyze Commercial Engagement in Health? We have a great broadcast for you today, and we'll begin with just a few announcements. This session is being recorded, and we'll post a recording on the HP Plus webinars page. Now, we would love to hear from you. We welcome your questions at any time. So please submit your questions via the chat box on the right side of your screen, and our moderator will read them aloud when we pause for questions. Now, these web conferencing platforms are getting a high amount of traffic these days, so we ask that you just bear with us in case there are any glitches with the technology. And finally, we ask if you are not speaking, please mute yourself to keep the line nice and quiet while others are talking. So that concludes our announcements portion, and I'll now turn it over to my colleague, Anna Gerard, a Senior Technical Advisor for HP Plus. Anna?
Hello, everyone. A very warm welcome to today's webinar. My name is Anna Gerard, and I'm Senior Technical Advisor in Private Health at Palladium. And it's my honor to join you as the moderator of this Health Policy Plus webinar to discuss how blended finance can catalyze commercial engagement in health. Next slide. Thank you. In terms of today's agenda, if we could just go back one slide. In terms of today's agenda, we're going to focus initially with a couple of presentations on recent insights into blended finance and health. The first is a USAID-supported activity looking at blended finance opportunities to stimulate the commercial family planning sector in India. And another one was undertaken in parallel on a similar topic, but focusing on a number of African countries and supported by the Gates Foundation. If we could move on one slide, please. Then we're going to move on to broadening the discussion and spending the remaining time discussing with you, the audience, on how risk-tolerant finance, such as that from USAID and other philanthropic partners, can be utilized to stimulate a larger and more diverse pools of capital from commercial investors, with the objective of increasing family planning and essential health impact in partnership with the commercial health sector. And we have a number of excellent speakers today to help us delve deeper into this topic. So before we move to opening remarks, I'd like to check in quickly with you all online by way of a short poll. So please, could you bring up the poll question? Thank you. We'd like to know what perspective you are bringing to the discussion today. Are you from the world of implementation, policy academia, entrepreneurship or innovation, or finance and investment? And we'll just give you a few moments to click and type in your response. Okay, Georgie, I can't see any of the responses. Could you jump in at this point?
Yeah, so we have about 59% of the people online come from implementation, 24% policy academia, 3% entrepreneur innovator, and 14% investor grant maker.
Okay, great, thank you. So the majority of you today are from the making the things happen in the field. That's great. So I think we can have a good discussion on sort of your perspectives on how to really make blended finance work operationally, so it makes the health impact happen. Thank you. So moving on to the next slide. With great enthusiasm, I'd now like to introduce Denise Harrison, who's going to open up the webinar with some key remarks. And Denise is Senior Market Development Advisor at USAID, where she provides technical support in the Commodities, Security and Logistics Division at the Office of Population and Reproductive Health. And Denise also served as the USAID point of contact on the Health Policy Plus activity, which we're going to present in a moment. And prior to joining USAID, Denise was Chief of Party at IntraHealth International and the Product Promotion and Distribution Director at IPAS. Welcome, Denise, over to you.
Thank you so much, Anna. And I want to thank everyone for coming to today's webinar. I want to especially thank the Health Policy Plus Project for carrying out this work and organizing the panel that shares not only their work, but the work of others. I'm also appreciative of the panelists, in addition to HP Plus, Salient Advisory, and USAID CII for their work and participation. Again, I'm Denise Harrison, and just to add to Anna's introduction, I'm also the activity point person for this HP Plus activity called Blended Finance Opportunities to Catalyze the Commercial Family Market in India. This work on exploring the possibilities of blended financing to increase family planning investment is timely and innovative. In this time of reduced donor funding for family planning commodities, namely those related to the FCDO cuts and increasing demand, it is essential to look for ways to increase private sector investment, especially investment coming from commercial investors. USAID isn't the only donor exploring blended financing. Gates is as well. Gates and USAID are coordinating their experience and sharing lessons learned. This panel is a part of the process. While Gates' partner, Salient Advisory, looked at this issue for local innovative sub-Saharan distributors and presented the results this past March, USAID looked at possibilities in Asia. We selected India because the country is a USAID priority country for family planning. While India continues to receive support for family planning from USAID because of its unmet need for family planning, it is known for its economic dynamism and innovation. It is also where several WHO pre-qualified manufacturers make contraceptives. Moreover, the USAID India mission is working with blended financing and is investigating its use beyond family planning, as we will hear from the panel. We look forward to hearing from the panel as well as from you, the audience, to provide input on how we move forward. I'm handing it back to you, Anna. Thank you.
Thank you, Denise. So next, I'd like to introduce the first of our two esteemed presenters. Firstly, we're going to hear from Thanik Vidivalu from Palladium. And Thanik is a finance manager at Palladium Impact Capital, which is Palladium's investment arm. Prior to joining Palladium, Thanik worked in inclusive business development at Action on Poverty and at the Commonwealth Bank of Australia. Over to you, Thanik.
Thank you, Anna. And as Anna mentioned at the HP Plus project, we recently conducted a USAID-supported study to understand how development partners can play a role in catalyzing the growth of local companies in India with an idea to expand access to family planning commodities. We began by studying the enabling environment to understand the role that regulation plays in hindering growth. We then looked at companies that are innovating on traditional business models and gathered feedback from interviews to understand how donor capital can help to increase access to financing. This included discussions with wholesalers, distributors, e-retailers, telemedicine providers, and also investors and family planning organizations. Next slide, please. Our assumptions going into the study were that blended finance can play a catalytic role in unlocking investment capital, but there's limited access to equity financing, and this is due to the scalability of the business models. And there are also challenges with debt financing because of conservative lending practices and also because this sector isn't really a priority for lending. And next slide, please. So the first business model we looked at was digital healthcare, which included e-retailers and telemedicine providers. And one of the major financing challenges for these companies is working capital, since they often face delays in receiving payments, especially from the government, which has a large presence as a buyer in the market. This makes family planning retailers less attractive for investment because they're impacted by unpredictable public procurement volumes and timelines. And these companies are also subjected to retail price caps that are reviewed very infrequently, and that can make it difficult to manage around since they're facing high annual inflation for their own input costs. A positive sign that we did hear was that the National Telemedicine Guidelines launched during the pandemic have helped to provide much needed guidance, but that's not mandated into law at the moment. Next slide, please. The other business model that we looked at was family planning, wholesale and distribution. For these companies, a major challenge is the high interest rates that they pay on loans, which can be anywhere between 10 to 15%, depending on whether or not collateral is being provided. And these are businesses that make an overall net profit of just 3 to 4%. And for family planning products specifically, the margins are as low as 0 to 2%. So the cost of financing has a significant impact for them. And also the process to take out a loan was also very time consuming. Companies are being asked to provide large amounts of data, which they may not always have readily available. And in terms of cash management, it's common for wholesalers to pay manufacturers on delivery for their products, but then they're often selling on to larger online retailers that can take 3 to 4 months to pay them. So working capital constraints and delays in getting approved for loans often leads to missed business opportunities for these companies. Next slide, please. And now moving on to look at the types of potential funding available, beginning with equity funding. Family planning specific business models are not lucrative for investors at the moment. And this is since it's a high volume and low margin sector, it's difficult for them to justify the risks that they'd be taking on. Equity investors are most interested in innovative business models that are using technology to scale quickly and to reach new markets. And they also need to be convinced that the model can be self-sustaining in the future. The feedback we received was that digital healthcare is very interesting to them, but to date, the focus has been on other segments of the healthcare market rather than family planning. And because of the high risks, investors prefer to wait until later capital raising rounds, and they can then rely on the numbers to tell them the story of whether or not the business model is actually working. Next slide, please. In terms of debt financing, banks are very conservative and reluctant to lend to early stage companies because of their own internal policies and also because of external regulatory pressures. And this was something that was expected and not unique to the Indian market or to family planning specifically. And commercial banks are most concerned with profitability at the company level, not so much about whether or not products are performing well or gaining traction in the market. So early stage companies with untested business models have a really hard time getting funding. And family planning entrepreneurs commented that banks might not understand their business models and compare them with other regular pharmaceutical companies, which have higher turnover and margins. And we also heard of a lack of flexibility from lenders when companies are faced with challenges making repayments, which has been the case even during the pandemic. Next slide, please. And this diagram summarizes potential options for leveraging finance to address some of these financing challenges. So at the top, the first option is a risk-sharing facility to enhance bank lending to wholesalers and distributors. This can help to bridge the gap between actual and perceived risks, with credit guarantees from a development partner such as USAID being combined with loans issued by banks. And businesses can benefit from this with improved loan terms, reduced collateral requirements, and potentially more efficient loan approval timelines. But it's important to note that this type of facility doesn't reduce banks' underwriting standards, and bank representatives we spoke to told us that requests for funding still need to be able to stand on their own merits from the perspective of the bank. So donor funding would not necessarily be designed to increase the amount of new loans being issued by banks, but rather to catalyze larger ticket sizes and then improve commercial terms where they can't underwrite the entire amount of capital. The next potential solution is the use of concessional capital to catalyze venture debt, and this is for micro and small e-retailers and telemedicine enterprises. In this case, USAID could strategically partner with commercial debt funds to provide loans on terms that are more favorable than the market rates. This can help to address the main challenge for challenges for these types of companies, and that's the high interest rates that they have to pay relative to the return on investment that their business models are able to generate. And concessions can also come in the form of more flexible terms being offered. For example, longer repayment horizons or moratoriums to help businesses survive severe disruptions, such as was the case during the pandemic. And for both of these potential solutions, the value proposition for commercial investors is that they're more likely to be able to meet their investment parameters. For example, a maximum acceptable level of risk for a given expected return. And there's also a competitive advantage since investors can acquire expertise in and learn about the family planning market with the comfort of some downside protection. The third potential area for support is the use of challenge funds to incentivize grassroots innovation for early stage and particularly tech-oriented enterprises. So equity investors indicated to us that the mortality rate for health tech companies at the seed stage was very high. So what's needed most is for a third party such as USAID to step in and help take these enterprises from the seed stage to a point at which venture capital funds would consider them attractive for investment. This can be a way to stimulate innovation and focus on the ultimate outcome of growing the market, but without prescribing the means of how it should be achieved. And recipients could be asked to match a percentage of the grant with their own financing. So donor funds can be leveraged without distorting the market. And lastly, there's potential for technical assistance funding to be combined with each of these solutions to enhance their impact. A common theme that continued to come up in our interviews was a real desire for technical assistance for family planning enterprises. And entrepreneurs said that some of the areas where this was most needed were IT expertise to help develop digital marketing platforms, technical assistance support to help with validating and fine-tuning business models, and also to provide guidance for company founders to address skills gaps that exist at the management level. So that's a summary of the challenges that currently exist in the family planning market and some of the potential solutions that we think could be relevant for USAID to help catalyze investments. I'd be happy to take any questions on this later on. Thank you.
Thank you, Thanik. That was really interesting. Yeah, so it sounds like there are some good opportunities in family planning emerging, particularly perhaps in digital health, but there are similarly lots of long-standing financing constraints that could be alleviated with blended finance. Now we'll move on to our second and final formal presentation with Maura Hansen-Staples from Salient Advisory. Maura is the founder of Salient Advisory, which is focusing on market intelligence gathering in health tech in emerging markets. And previously, Maura co-founded Impact for Health and worked at the Gates Foundation, where she led a $100 million plus portfolio to improve coverage of primary healthcare through health financing and private sector engagement. I'll hand it over to you now, Maura.
Thanks, Anna. Great, look forward to presenting. This work I'm presenting on behalf of my colleagues who are based in Lagos, Nairobi, and Canada, and our partners at Southbridge ANI, who are based in Morocco. If you go on to the next slide. As Denise said, this investigation looked at a very similar question to the presentation you just saw, but was focused in 4 geographies in Africa: Kenya and Nigeria that have large private sectors, and Uganda and Ghana that have more emerging markets in this area. Go on to the next slide. Similar to the work we just saw presented, we focused on startups and mid-sized distributors in the value chain and the role of blended financing to support the growth and efficiency of these business models. Next slide. We completed this work in early 2021, funded by the Gates Foundation and guided by a learning committee that included members of, from the DFC, the IFC, folks from USAID, CII, Denise, and others. So if you head into the findings, first we'll dive into the findings for the mid-sized distributors. If you go 2 slides ahead, that would be great. So importing distributors in these contexts face a myriad of challenges, which are laid out on the right-hand side of the slide, kind of from top to bottom. And these challenges include very long import lead times, a need to pay upfront and in cash for those imports, resorting to the use of expensive lines of credit, the requirement to pay for these imports in hard currencies in context where access to hard currency is limited and expensive and parallel markets drive up the price. They also face minimum shelf life requirements, which constrain purchasing, and very long product registration timelines, which limit the products they can even bring into the country. So in this context, access to credit is also exceptionally challenging. Suppliers don't appear to offer credit to customers. They often require upfront cash payments for these products. And when the supplier credit is offered, the mismatch between the local currency sale and the foreign currency payable can be very difficult to manage. For banks to provide letters of credit, the transaction often needs to be fully backed with cash or titled property as collateral, which is very difficult to fulfill. Finally, customer repayment cycles are very long and can be even longer for government purchasers. Very few of these sales are in cash, and the businesses have essentially no recourse for customers who don't pay. In these contexts, some banks are offering products like working capital loans, but they're very costly. Private equity investment does exist, but only the largest companies are aware of these actors. If you go on to the next slide, the key informants again highlighted the need for prepayments, the lack of willingness of local banks to fund where public institutions and debt are involved, challenges in accessing foreign currency, and then issues again with product registration. If we go into the findings with startups, as you all likely know, this space across the African continent is really growing, but mechanisms to effectively support these companies are still quite limited. You can skip the next slide and we'll dive right into the challenges. So most startups are focused on disintermediating the supply chains by interfacing directly with suppliers and offering their customers lower or more reliable prices. Thus, many are importing medicines. Like mid-sized distributors, startups also report needing to pay suppliers within 30 days of ordering, but unlike the mid-sized distributors, they don't report needing to pay suppliers with cash. Nevertheless, upon importation, they need to execute payments in foreign currencies. And while some companies have venture capital investments in foreign currencies that can fund those transactions, those without venture capital struggle to access the affordable currencies in a timely fashion. Interestingly, startups report much shorter customer payment times than the mid-sized distributors. Thus, they appear to have much shorter cash conversion cycles, though this may shift as their operations grow in size. So if you go on to the next slide, again, the key informants highlighted that startups don't have access to adequate access to loans in local currency. They have to contend with stringent collateral for those bank loans. They lack access to volume pricing. And unlike the incumbent distributors, they experience market entry barriers as a result of inconsistent or unpublished regulations in focused geographies. So if you go on to the next slide, in summary, we identified 5 key needs, which will sound very similar actually to the needs in India. For the startups, we still see they have limited access to risk-tolerant grant financing, especially those companies who lack strong ties to high-income countries. Really high-quality programs like we see in high-income countries, such as those led by institutions like the NIH that use grant funding and professionalized support to finance innovation in this space, are not yet available in these contexts. Secondly, for startups and distributors to import seamlessly, they need access to foreign currency with reasonable terms and without substantive delay. Third, companies require better access to working capital in their local currencies and lower cost of debt through structured collaterals. And finally, for startups to expand their scale and scope, they're facing challenges with facility licensure, product registration, market entry, minimum shelf life requirements, and these unavailable or unpublished regulatory guidelines. So improving those regulatory frameworks will really help enable their growth and efficiency. So on the final slide, we just posed 5 ideas to address these challenges, and I'll highlight today 3 of them. The first was to develop a new grant funding mechanism to support early and growth stage startups with both highly risk tolerant financing as well as professionalized support. The third was to develop a scalable risk assessment process and power a Pan-African debt fund for affordable local currency loans. And the fifth idea was that we called for support for regulators to help strengthen the e-pharmacy guidelines as they're developed and implemented across the continent. Thanks, I'll pause there and look forward to the discussion. And I'll also place a link in the chat, which will give you access to the full report.
Thanks so much, Mara. Yes, lots of similarities with India we see, particularly with sort of the cash conversion cycle. So thank you for that. And we look forward to sort of discussing sort of more of the overlaps and challenges and differences later on. Now we're going to shift gears a little and move into our panel discussion. So whilst our panelists are discussing, I would encourage participants online to start sharing your comments or questions in the chat box, which should be to the right of your screen. And we're going to come to those questions shortly. So I'd like to extend a very warm welcome to Monisha Ashok and Sushant Bhatia and invite you both to join Mara and Thanik in exploring this topic further. Monisha is Senior Advisor for Market Access and Innovative Finance at USAID's Bureau for Global Health Center for Innovation and Impact, or CII, where she leads value-based care and blended and innovative financing initiatives. And previously, Monisha was at the Boston Consulting Group. And Sushant is currently the Senior Investment Manager with Caspian Debt, where he leads their strategy for South India. And he helps high-impact enterprises in healthcare, education, and clean tech sector access customized debt capital. And prior to joining Caspian, Sushant worked at FinCare Small Finance Bank. Welcome to you both. Thank you for joining today. Firstly, let's start with a question for you, Monisha. At CII, you've been supporting a number of blended finance initiatives across India and Africa to mobilize private investment into health, including the Adafi loan guarantee for private health clinics in Africa in the wake of the pandemic, and the Utrecht Development Impact Bond, which Palladium was involved in for private maternal and child health clinics in India. So tell us a little bit more about CII's approach to blended finance and sort of what sort of opportunities you see in the near term to address some of the critical gaps in health financing.
Great, thank you so much, Anna, and thanks to Mara and Thanik for those presentations. I think they actually touched on a lot of what CII has been trying to do within global health. And so CII, or the Center for Innovation and Impact in the Global Health Bureau at USAID, focuses on innovation, market access and financing, and digital health solutions. I'm in the market access team and lead our innovative finance portfolio, which includes both blended finance to try to attract more private capital for global health innovation, and also outcomes or results-based financing that tries to use that capital or resources more effectively and efficiently. And so we work in partnership with other stakeholders in the global health financing space, particularly the Development Finance Corporation's Health and Prosperity Initiative. So that's really opened up a lot of additional tools that we have for health financing. So I'll just expand on the two examples that Anna already provided to give you a sense of the types of innovative financing initiatives that we've supported in the past. So the first is the ODAFI, or the Open Doors Africa Private Health Initiative. We love acronyms in USAID. And so this was developed right after the COVID pandemic. We saw that many small and medium-sized health enterprises, pharmacies, clinics, even small hospitals were at risk of closure just because they were seeing a sharp rise in their costs. Now they have to purchase PPE and other equipment, a drop in their revenue as patients were either delaying care or just not seeking care at all. And then a credit crunch from local banks, as you heard from Danik and Mara, that many of the local commercial banks can be quite risk averse, and their interest rates were increasing. So at that time, we partnered with the President's Malaria Initiative, which a lot of over 50% of malaria treatment is provided in private health clinics in many countries in sub-Saharan Africa. And we partnered with the DFC, with the Health Finance Coalition, which is a group of leading philanthropists, including Gates Foundation and Rockefeller and Skoll and MCJR, Amelia Foundation, to set up a loan guarantee program. And this is a common tool that USAID has at its disposal, where we can subsidize the risk of a partial loan or credit guarantee that the DFC then provides to a local financial institution. In this, it could be a bank. In this case, it was the Medical Credit Fund, which provides working capital loans to small and medium-sized enterprises. And so a small catalytic investment from USAID in $700,000 translated into a $17.5 million loan guarantee, which then enabled over $35 million in working capital loans that will go to over 1,500 health facilities and enterprises across Africa. And then the other one that I'll mention is our Financing for Moms initiative, which is also a blended finance model and partnership with the Development Finance Corporation, DFC, Merck for Mothers, and Credit Suisse, that provides a mix of debt and grant capital and TA to innovators focused on maternal health and reproductive health as well. And for USAID, the role that we play is around technical assistance and helping these innovators, perhaps enter new markets or to reach new populations and really achieve that health impact. So going beyond the financing, but providing the other technical assistance that they need to scale. And many of those approaches could also be applied to family planning or reproductive health. So looking forward to digging into that a bit further. Thanks. Back to you, Anna.
Thanks, Manisha. That's great. So next we'll move to Sushant. So as an investment manager in India, you've overseen a number of private investments into health and other high impact sectors. And I mean, really, you're doing sort of the hard work in making it happen. So we'd love to hear your perspective. Danik, for example, talked about the role of concessional debt capital and challenge fund mechanisms to stimulate investment into health. Are these and other blended finance approaches something which would make a difference for banks providing debt financing or for venture firms, debt firms like Caspian? Tell us a little bit more about your work and what you've been seeing in the health space in India.
Thank you, Anna, and thanks to Danik, Mara, Manisha for the views. Very interesting, and I find it really interesting that India and Africa have almost similar problems, which I think makes life easier for enablers and financiers to provide solutions that can be replicated. So quite interested in learning more. To talk about our work in the context of blended finance, maybe let me give you a quick background about what we do. Caspian, the organization manages multiple funds. Caspian started as an equity investor. We invested very actively from 2004 till 2013 into the financial inclusion space. These were pure equity investments. Since 2013, Caspian launched its own lending company. It's called a non-banking financial company in India. And since then, we have been very active in providing debt capital to high impact enterprises across sectors. And healthcare is one of the key focus areas for us, when we have funded now 17 enterprises in last 6 years when we started looking at the sector itself. And the blended finance opportunity came in very recently, and I'll talk very shortly about it. But to answer your question very specifically in terms of banks versus the venture debt funds, how can they leverage? I'll talk quickly about banks first, from what we have experienced, and I worked in a bank before. In India, and this is also, I think, reflected in Danik and Mara's presentation, banks are not actually designed to cater to this segment. And we have learned this through multiple experiences over the last 8 years. I'll talk more about India. Banks are designed to be credit or risk averse, and they cater to mid to large enterprises quite well. But small to medium enterprises are considered very high risk, especially the startups and tech-enabled companies, because the businesses do not have enough collateral, and many of them, the entrepreneurs are first-generation entrepreneurs. They do not have enough assets and collateral to provide. And so by default, banks just assume this to be a very high risk segment, and that's in fact the reason why organizations like us exist. Caspian Debt kind of fills a gap which we identified, where banks are typically finding it very difficult to cater to the segments. So banks actually lend to us, and then we own lend to enterprises in healthcare, education, and so on. So my experience is that if we are providing larger financial institutions like bank this access, this will only give them a nudge, which is very useful, because we have found 1 or 2 banks really interested in exploring this segment. So in a way, a nudge will be provided, that is good, but it will not move the needle much. What will move the needle is providing blended finance access in partnership with institutions like Caspian Debt, because we have direct experience and we focus only on the segment we're talking about, right? So for example, we deal with in terms of ticket sizes, we deal in $100K to $2 million, and that's where the big gap lies, and that's where the small and medium enterprises lie. And so blended finance, I'll talk about the second part now, and how we practically have experienced it. So it was in the middle of pandemic, and it was actually second wave in India, and I'm talking about March, April, so 7 to 8 months back. India was in grip of the second wave. The country was kind of falling short of beds, falling short of oxygen, and that's when we actually got a request from one of our portfolio company called Collateral Medical. Now it's a distributor of medical equipment, which kind of enables access of small to mid-sized equipments to tier 2 and tier 3 market, urban and semi-urban clinics and hospitals. And they were really getting demand surge for oxygen concentrators at that time. Now when they approached us, we had already had maxed out our exposure to them. So in terms of our credit risk, we found very difficult to evaluate them. But parallelly, we were in touch with the blended finance facility which USAID was launching. Again, it is called Samridh. As Monisha was mentioning, it's a very complex acronym. Now I know they're fond of launching this. Samridh is a very beautiful word in Hindi. So we and that was a great opportunity for us, and I quickly got in touch with them. They provided us a risk capital, and we kind of leveraged it 2x and funded the company within 2 weeks flat. I mean, because we already had them in a portfolio, we knew about them, and we gave that comfort to the Samridh team as well. And they were able to procure oxygen concentrators, and again, lives were saved. So it was very, very practical, very, very first-hand exposure in terms of impact and blended finance, and enabling credit for us where we had maxed out our limit, right? Another example, which is again unique, is a company called Black Frog Technologies. This is a tech startup, and which is into cold chain logistics. They have innovated with a very portable device which can help transport biologicals like vaccine. Again, in a geographically diverse country like India, it's very important that the vaccines reach the last mile. Now, Black Frog had already launched their product successfully, and they had started receiving orders, bulk orders from state governments, in fact from other countries as well. But they were falling short of capital to even start manufacturing or outsource manufacturing, right? Because vendors were asking for advances, again, this came out in discussion with Tanik, Monisha, and Mara as well. So this working capital gap sort of became a crunch, and nobody was really looking to lend to them because it was high risk. They had no vintage. It was like a 1.5-year-old startup. Again, a great opportunity for us to collaborate with the Samrid team, because in our usual underwriting, we could not have lent to that company. This blended finance, and they gave us a guarantee, and we could enable access of capital to them, which was really the crunch for them. And we are looking forward to them scaling up. So we are seeing real life examples which we kind of quickly partnered and were able to go live with, which really gives me hope. And after hearing about Africa and India, I think there is a huge potential in this. Thanks, Anna.
Thanks, Isha. That was great. I really liked your point around nudge versus moving the needle, and sort of there are different roles for different financial institutions depending on what you want to achieve, and sort of all that packaged together is an important part of making things happen. So next I have a question for Mara. Mara presented to us a few, three, I think, options that they were looking at earlier this year. I'd personally love to know a little bit more about next steps, what you've been doing in the meantime, if you could touch upon that. Thanks.
Sure, thanks so much. So if I start from the bottom, the last recommendation, and move up, on the regulatory side of things, we were really privileged to host a small sort of closed door meeting with the regulators, the pharmacy sector in each one of the 4 countries we focused on just about 6 weeks ago to share sort of the e-pharmacy guidelines that are either in development or that are in development in each one of those countries, and look for opportunities to share and learn from one another. And I think there's tremendous opportunity for more partners to help support these regulators as they wrap their heads around the regulation in each one of these countries, and think towards regional and continental wide regulations that can help enable startups to expand more rapidly and effectively while maintaining patient safety. On the third idea, which was around working capital facility that raises funds in local currency to avoid those hedging costs, we were really excited to see new work that Monisha explained with the medical credit fund being laid out. But I think there's even further to go in this space, especially around raising money in local funds, which will allow you to avoid those hedging costs, which are, we estimate, around about 10%. So we think if organizations are able to raise funds and offer a product like the medical credit fund is offering, but raise those funds locally, the cost of those loans could be reduced quite significantly, which is very powerful. On the final idea I raised, sort of organizing around a better mechanisms for deploying grant capital in this space. We are working right now with the Gates Foundation, the Children's Investment Fund Foundation, to try to assemble a group of industry actors, donors, and African institutions to launch a new grant funding mechanism in 2022. This design work is underway and is certainly meant to build on the activity on the continent that's really been developing over many years to support innovation ecosystems and help superpower some of those innovation hubs to turn their eye to health tech and enable some of our clients to better funnel their grant financing towards those local innovation hubs in a way that can make a difference. So that's what we're pushing ahead on, but I know this is a really dynamic space, and we're really excited to learn from others, to work alongside others, and both on the African continent, but like the conversation has allowed for today, to learn from folks all over the world.
Great, thanks. Yes, the regulatory frameworks are really important. I think it's something we sort of think about as a sort of after point, but actually can have a really big impact on how far investment can make a difference. Danik, tell us a little bit more about some of the regulatory issues you encountered in India in the study and sort of how they played out with looking at the financing solutions that you proposed.
Yeah, sure. Thanks, Anna. So we did, well, the focus of our research was really on financing challenges. We also looked at non-financing challenges, and there were quite a few, particularly facing the micro and small enterprises at the moment. So firstly, there's barriers to task shifting in the commercial sector, and that limits the cost effectiveness of their business models. And many modern contraceptives are designated as prescription drugs, so they require a licensed medical provider to authorize them. There are also limits on advertising of prescription drugs. So some can't be advertised at all, while others can be, but only at certain times of the day. And the rules apply differently to the government and to the commercial sector. So entrepreneurs have told us that it's not really a level playing field at the moment, and that makes it challenging for them. Also, the process for clinical trials and gaining approval for registration of some products, such as implants, can be very lengthy. So all of these create challenges for these companies, along with the retail pricing caps that we mentioned before. And so this all limits the return on investment for commercial players. And then that in turn affects the attractiveness of these companies for investment by commercial investors. So there's an interplay between the financing challenges and the non-financial challenges, which affect the prospects of these companies in the future.
Great, thanks, Danik. I just want to shift gears a little bit and talk specifically about family planning. And I'd encourage everybody online to start typing in their questions or comments into the chat box, because we'll move very shortly to those questions. Monisha, a question for you. Although CII is yet to support any blended finance opportunities in family planning, do you think this could be an area to explore further? And if so, what is the starting point?
Great, thanks Anna. I think there's a lot of opportunities for applying some of these approaches to family planning and reproductive health more broadly. So in terms of kind of attracting new capital, I think we've already touched on a number of these opportunities to use public and philanthropic capital more catalytically to absorb risk and bolster the returns to bring in capital for these kinds of innovators. And it's great to see that there's already investments being made in this space. So for example, the DFC's first equity investment is in a company called Kasha, which is an e-commerce platform in East Africa that provides a range of health products that includes contraception and other reproductive health products. And I know that I believe the Gates Foundation and SIF and others have been looking at streamlining some of the regulatory and policy issues around e-commerce. And so that could really open up more opportunities for investment in these kinds of platforms that offer contraceptives or other reproductive health products. And the nice thing about Kasha is that they also have a delivery model that really emphasizes discreteness and kind of direct delivery to women and girls. And so that's heartening. And then beyond that, there's also a number of different approaches to use capital more efficiently and effectively, and that itself can help catalyze more resources. And so, for example, the Utkarsh Development Impact Bond that Palladium has been an integral part of, in that UBS Optimus Foundation is the upfront investor, and they've been working with implementing partners like PSI and HLF PPT to improve the quality and standard of care for maternal and reproductive health in private clinics in Rajasthan, India. And if those outcomes are met as verified by an independent evaluator, in this case it's Mathematica, then USAID and Work for Mothers repay UBS Optimus with a return on their investment. And so this not only brings in new capital from investors like UBS Optimus Foundation, but also incentivizes the clinics and the implementing partners to improve their efficiency and effectiveness and improve the quality of care. And so that for now includes primary care, that could include reproductive health, but could also be replicated in a way that's more targeted to family planning and reproductive health as well. So, looking forward to working with Denise and others on exploring how some of these concepts could be applied further to family planning and reproductive health.
Thanks, Manisha. Anna. Just a follow-up, I see we have a question in the chat that's sort of related to this. So sort of about the use of finance and blended finance to overcome sort of the non-financial challenges that you just talked about. How important is that in making things happen and making sort of the models of blended finance work?
Yeah, hugely important. And I think others have touched on this already. There's kind of across the value chain, there's definitely the regulatory piece to make sure that the product or service is has the right approvals and support from local authorities. There's then sort of the health system integration, so making sure that if it's being used in the public sector, that the doctors or nurses or whoever is using it is trained, that it's integrated into, say, their training programs, and really being rolled out at scale, typically in partnership with the public sector. And then there's also just like the monitoring and evaluation of the health impact, throughout the implementation. And so USAID and other traditional donors can also play a role in providing technical assistance to these companies throughout their life cycle. And the other piece around blended finance is it can providing grant capital, which can absorb that risk, also enables some of these companies to expand their reach to either lower income populations or maybe even more fragile settings if they're only relying on commercial capital or debt or equity, they may be inclined to go a bit more upmarket and focus on maybe higher income populations or countries. And so there's, I think, a large role for USAID and other donors to play beyond just the direct financing of these companies.
Yeah, great point. Sushant, I sort of turn to you to look at sort of the opposite, the implementer side of this. I mean, what gaps do you see that could be addressed by sort of grant finance technical assistance through this sort of blended finance approach, which would make health enterprises particularly more attractive from the perspective of Caspian and your role in India?
Yeah, thanks, Anna. I think we see companies, entrepreneurs broadly struggling with two things, and it's also applicable to other enterprises, but we have seen this a lot within healthcare and within this 1 to 4 year old enterprises. One is the product validation and distribution. In fact, that's where we saw BlackRock struggling. They had already done successful pilots, but a large-scale validation and the distribution was their bigger problem. I think there is great opportunity for philanthropic capital here, grants coming in here, because you'll see results also immediately, and it really matters. And the second issue which we have seen across sectors, especially high impact sectors, the small and medium enterprises, because they have so many other challenges and issues to deal with on daily basis. They're talking about new products, they're talking about product market fit, they're talking about collecting payments from customers, governments. They somehow forget that internal controls and reporting matter a lot, especially to grant makers, lenders, investors. We see them struggling when we ask for data. I think that's where some sort of technical assistance would be really meaningful, and it can be measured as well on how do they improve. And this is, I think, a low-hanging fruit, which can again leverage multifold results. So yeah, two things on my mind, Anna.
All right, thanks for that. So I'll just briefly go back to Monisha. So in terms of scaling the investments you've already made in these different approaches, we've heard from Thanik, Amara, there's so many overlaps with different geographies, and there's so many opportunities for sort of scaling approaches, blended finance solutions. how far are these finance mechanisms being replicated across countries, scaled, in countries, or scaled beyond that and regionally?
Thanks, Mara. I think blended finance for health still feels like a nascent field to me, and so lots of opportunity for growth. But it is exciting to see that a lot of these initiatives are getting replicated, at least across South Asia and in Africa as well. And so, for example, we were working on a blended finance fund, and then in the meantime, we saw Samrid, the partnership with Caspian and USAID, get stood up already in response to COVID. And so now I think we're in the midst of trying to stand up something like that on a global scale. And so our Unleashing Private Capital report, which outlines a lot of the same barriers that were discussed today for investors and innovators, led to the design of a private capital fund that uses public and philanthropic capital as a first loss guarantee to, again, absorb that risk and bolster returns to bring in new capital. And so that kind of tiered capital structure with using blended finance, we're hoping to stand up at a more global scale. But and then the working capital facilities are there. The DFC has, in partnership with USAID, has a number of loan guarantees across LMICs. So that's similar to the ODAFI model. The development impact bonds, there's a couple that are focused on health. There's another one with living goods in East Africa, and there's a lot in the process of being stood up as well. And so we are seeing a lot of these models get replicated. I think there's still a gap in getting kind of the local public sector to be outcomes payers and really participate in these models. There's still a gap in kind of attracting new private investors who otherwise wouldn't invest in health. So there's still a lot of opportunity for growth. And then I think there's still, again, a gap in developing a large enough pipeline of health innovators that are at that growth stage and ready for this kind of blended finance. So starting to see these models get replicated, but still a lot of growth opportunities as well.
Yeah, great. Okay, lots of opportunities then for us to move forward in health. We're 3 to the hour, so I'd sort of like to close the questions round. Thank you so much, everyone. But before we end today, I'd like to give each of you panelists a short moment for a very brief closing remark. Let's start with you, Thanik.
Oh, thanks, Anna. So one thing that quickly became apparent to us when we were doing the research is, while there's a really thriving entrepreneurial environment in India and there's a lot of innovation taking place in the health tech space, there's specialized family planning models in isolation are very rare there. So any efforts to grow the market should focus on healthcare companies that include family planning as part of their wider product offering, rather than just being the sole focus of their business.
Yes. Mara, would you like to go next?
Sure. I think my only closing thought would just be sort of to echo what Monisha said. Many of these barriers have been well understood for quite a while. And I think it's incumbent upon those of us within the development community to go further in taking risks to establish the next generation of financing mechanisms that are required to support local companies to replace all of those of us who sit in high income countries, all of our jobs. And the explosion of entrepreneurship that we have seen across the African continent amidst COVID is unbelievably inspiring. So if we're serious about supporting local businesses to take our places, now is the time to innovate with a high degree of risk, with smart approaches, with partnerships, and with a willingness to fail to meet those entrepreneurs in this moment and to develop really sustainable sort of next generation models for care delivery. So I just want to call on all of us to proceed with boldly, because I think these ideas are not necessarily new, but action has been really limited.
Thanks, Mara, for that inspiring call to action. Yes. Monisha, would you like to go next?
Just really seconding what Mara already said, that COVID has been a watershed moment and has really pushed all the stakeholders to be bolder. And the next generation of solutions is really going to come from local private sector health innovators. And so finding new ways of working and new ways to support them to scale is going to be our biggest focus going forward.
Great. And Sushant, final remarks from you.
Yeah, absolutely echo Monisha's and Mara's thoughts. It was a pandemic that kind of nudged us into action. I hope we don't require another pandemic to kind of spread whatever we have built, right? So specifically in context of blended finance, what we have realized it's like a win-win-win-win for 4 different stakeholders. For lenders, for borrowers, it increases the affordability and accessibility. For donors, it provides biggest bang for the buck. You can really leverage and reach out to the masses in terms of impact. And of course, the beneficiaries, bigger the reach, and better it gets. Yeah, thanks.
Great, thanks all. Over to you quickly, Denise, for some final closing remarks to end the webinar. Thanks.
Thank you, Anna. I want to thank all the panelists for the presentations and the audience for their engagement. I think this webinar has left us a lot to consider and think about when it comes to advancing blended financing for family planning supplies and essential drugs in sub-Saharan Africa. The panelists and discussions see that while there are barriers to increasing access, such as regulatory and pricing constraints of the tech industry and digital health, as well as opportunities to expand the method mix, may make it possible to attract commercial investment, especially if donors reduce the risk of investment, as highlighted by HP Plus and Salient Advisory. So examples from CII illustrate outcome-based financing and e-commerce platforms have worked in India. Salient Advisory has illustrated innovators in sub-Saharan Africa are increasingly leveraging digital product marketplaces, pay-as-you-go financing, vendor-managed inventory services, direct-to-consumer e-pharmacies, and more. And in some cases, the solutions proposed by both HP Plus and Salient to increase access to capital and scale are similar. So all the work and comments showcased today seek to improve the affordability, availability, quality, and access to family planning and essential health products through commercially sustainable models. As Salient said, this is a very dynamic space. As both Salient Advisory and CII said, we need to be bold and go forward with next-gen financing instruments. USAID looks forward to leveraging these results and your engagement to move forward with blended financing. Thank you again, and we look forward to staying engaged. Thank you, everyone. Have a good rest of your day.